heart of where innovation, money, and power collide in Silicon Valley and beyond. This is Bloomberg Technology with Caroline Hyde and Ed Ludlow.
I'm Caroline Hyde at Bloomberg's World Headquarters in New York.
And I'm Ed Ludlow in San Francisco. This is Bloomberg Technology.
Coming up, we'll get the outlook for investing in the tech sector. That's as Goldman Sachs says that those stocks are poised for an earnings-led rebound.
And we'll have the latest updates from Google's antitrust trial as Microsoft CEO Satya Nadella takes the stand.
Plus, we'll get a read on the state of the EV industry. Some mixed numbers coming out of Tesla and Rivian. We'll dig into those in a moment. But first, let's check on the broader public markets right now, because we're dictated by macro moves. We're dictated by, of course, the eyes on what Fed Chair Powell have been saying at his roundtable, and indeed the direction of travel of bond markets. Nasdaq up by 0.3%. We were up more than a percentage point at one point. The 10-year yield probably curtailing some of that rally. 12 basis points to the high side, and the 10-year now high since 2007 once again with 4.69. So really a focus on where the Federal Reserve has to relay the pressure to fight off inflation. In fact, some inflationary pressures coming off the boil when it looks at commodities today. We're off by 0.9%, oil coming down, but really this is a question of growth. Let's move on to what's happening in, well, the area that some might have said was a commodity, but really this is a risk asset. We're up 3.4% on Bitcoin. We'd have quite a stellar rally to start this new quarter, Ed, where maybe we're seeing a little bit of repositioning into the riskier assets at the moment. But dig into the micro.
Yeah, we got third quarter delivery numbers for the EV space, Tesla and Rivian. Actually, both stocks fell in pre-market trading when those numbers were posted. They have come back, and we are notably higher compared to where we were into the trading session. Tesla, 435,000-ish EVs delivered in the quarter just gone. They're saying that downtime for factories as they retool for a next-gen Model 3 in the Cybertruck did impact some of their production figures, but deliveries also missing estimates. That was quite interesting. Rivian actually beat expectations, both on production and deliveries, but maintained guidance at 52,000 units for 2023. Some in the market saying, come on, Rivian, you can do better than that. Maybe there was hope that they would update their guidance. We're kind of starting this week, Caroline, much as we ended last week, which is thinking about antitrust and thinking about some of the mega cap tech names. All of them markedly higher in Monday's session. The news that we'll get into shortly is that Microsoft CEO Satya Nadella is on the stand in the Google antitrust trial that the government has put on focus on search. The kind of top line is that, according to Nadella, it is bogus, quote, the idea that there is choice in the search market. And we will bring you those details later in the program.
Yeah, we've got to dig in on the antitrust feeling of things, and indeed what it means for a market that's been so under pressure. Just think in the month just gone of October, the Nasdaq was off by 5.8%, having its worst month since December 2022. So what does October bring? Denny Fish is with us. He manages $4.3 billion in Janus Henderson's Global Technology and Innovation Fund. And really, we do have these headwinds. Ed pointing out the regulatory headwind, but is there going to be a buying opportunity into technology as it stands for October, Denny?
Well, it's always hard to tell, on a month-to-month basis, but clearly September was a difficult month, and it was a confluence of events. As we know, and, as Ed just talked about in the lead-in, the 10-year continues to rise. That is generally a headwind for growth-oriented stocks, just the way you discount them. But then secondly is the 10-year isn't going up because economic growth is robust. It's going up because inflation pressures continue to persist, and the Fed's indicated that it's going to be, higher for longer. And so I think investors needed to digest that. And so where we go from here is, earnings, as you talked about, and October brings earnings season. It's going to be a tug of war, I would call it, depending on, it's going to be a lot of idiosyncratic stories. And if we just look at the most recent reports, for example, from companies like Adobe and Accenture that had August quarter ends, Accenture's was much more muted, definitely some more macroeconomic headwinds associated with their results. But then Adobe, that has some unique drivers in its business and is on their front foot with AI, actually put up very, very nice numbers and, expectations to be strong going forward. So I think, it's going to be a case-by-case basis.
Denny, one session a market does not make. I get that. But let's show the mega caps again. Alphabet up 1.8%. We talked about AI. We know about the macro picture right now. the kind of acceptance that rates will be higher for longer. But did the share prices on your screen have any basis or priced in reflecting antitrust, what's happening in the courtroom right now? Is there any investor concern at all?
Yeah, well, there absolutely has to be. And what's interesting, the one name that isn't on that screen is Apple. So if we look at them, Google, Microsoft, Apple, they're all intertwined in this as it relates to default search. And it's really, really important because Google effectively pays Apple an exorbitant amount of money. There are many different estimates out there at what it is to actually be the default search provider on iOS. And that, is, those are the most important consumers in the world, effectively. And so it's a very, very virtuous relationship. Microsoft would love to be able to compete for that business, given their investments into Bing and particularly what they're doing with ChatGPT now as well. But the reality is, Google's been able to, quote unquote, corner the market. And that is the government's case, is that Google is exercising market power, or Alphabet is exercising market power in this default relationship. The hard part, though, is, Apple's the one that is actually kind of the toll taker here in terms of actually dictating the terms, but also it's a result of the idea that Alphabet has the best consumer experience for search. So it's not as though consumers are being harmed by any means. And that's where the antitrust laws and these cases are evolving because they're very different than what we've seen historically.
But this is interesting for you in particular, Denny, because you look at your portfolio, right? You have some exposure to Microsoft and to Apple. Which one are you most concerned about? There are a number of possible outcomes, of course, but which one carries the most risk based on what you just outlined?
Yeah, that would be Apple, because Apple's generating these what are called traffic acquisition costs from Alphabet today.
Yes.
They're 100% gross margin. They fall straight to the bottom line, and that's money that Apple can reinvest into its business and would be a material earnings hit if they actually weren't able to capture that. Today, Microsoft gets nothing. So Microsoft could pay twice the amount that Alphabet pays to be the default search provider, and it would actually be incremental to the business. The challenge is Bing doesn't have the critical mass, and so they don't get the same advertising density and the same returns on advertising spend that Alphabet gets. So there are a lot of things to think about, but it's all upside for Microsoft. It's, could be downside for Apple. And clearly would be downside for Alphabet if the most onerous outcome actually came to fruition.
And what's been so interesting, Denny, about the timing of all of this is that, well, Alphabet search is having a run for its money from a competition perspective from generative AI. And many had wondered whether Bing would suddenly come to the fore with the power of OpenAI. Of the names that you're putting your attention on, when you have such a large exposure to Microsoft, I think is number one, but you've also got NVIDIA in there. You've also got, of course, ASML. All these companies have an AI uplift here. Is it priced in yet, do you think?
Well, actually, with the market, it's interesting. Coming into this year, nothing was priced into these stocks as it related to AI. And then we got a lot that was actually priced in. And now, if we actually look at the estimates and the valuations of these companies, they're actually all still fairly reasonable. I mean, if you go back to September of 2022, the market expected NVIDIA to earn somewhere around $5 in 2024. The market now is expecting NVIDIA to earn $16 or $17 in 2024, meaning the estimates have gone up 3x, and the stock actually hasn't gone up that much. So you could argue NVIDIA is cheaper today than it was in September of 2022, despite the move. Microsoft now is back to one of its most reasonable valuations that we've seen in some time. Google or Alphabet still trades sub 20 times earnings. I mean, so you look at these, they're not egregious by any means, and the fundamentals actually continue to be just fine for all of these companies, if not robust in some of the cases, like NVIDIA, for example.
It's interesting. It feels as though you are aligning with Goldman a little bit here in terms of, yes, valuations might ostensibly look quite high, but actually when you're looking at the fundamentals of this business, actually there's still relatively opportunities, is certainly what Goldman sees when we're looking towards earnings. Where is the risk factor when you're looking sort of at companies that are being eroded by the opportunity of AI? Where isn't deploying it fast enough, thick enough at the moment from your perspective?
Yeah, absolutely. There are companies that are, we sort of go through this exercise of draw a line down the middle of the whiteboard and who's on the right side of time and who's on the wrong side of time of AI. And, I mentioned Adobe earlier as a company that, it was actually, if we go back 9 months ago, was viewed as being clearly on the wrong side of time. And as they've been able to actually communicate with the street more clearly as to their product roadmap and actually deliver on products and put up results, the company is now firmly on the right side of AI. And so one of the things that I think is really interesting in this market, we have the obvious winners, and I think we have some obvious losers, and then we have some companies that maybe are perceived as losers that then can move into that winners bucket, and we're really focused on trying to find some of those as well.
Denny Fish, Janice Henderson, we love the winners and losers conversation here on Bloomberg Technology, particularly around AI. Thank you. Now, coming up here on the show, the trial of Sam Bankman-Fried is coming up this week, and we're going to be joined by Duke University's Campbell Harvey about the significance of this trial for the industry, somebody that the defense called upon and said no to testifying. This is Bloomberg. Sam Bankman-Fried is getting ready to go to trial for what prosecutors allege was one of the biggest financial frauds in U.S. history. For more, I want to bring in Campbell Harvey, professor of finance at Duke University, who was asked to be an expert for the defense in this case. And Professor Harvey, you declined to give expert testimony. Why? Why did you decline?
I have to admit, I was very tempted because it's such a fascinating trial, and to be teaching my classes from the courtroom on Zoom could be pretty entertaining for my students. But in the bottom line, there were a few reasons that I declined. And probably the biggest reason is that if I do this type of testimony, the deal is that I tell the jury what I believe. And that usually knocks me out.
So why would that be a problem? You've been, the idea would be that you've been called as an expert witness, right, to assess a bigger picture rather than of the individual action. Why would that be a problem?
So it's often the case that experts are engaged to support the point of view of whoever's hiring them. And given my reputation, which I consider very important, I'm just going to tell what I believe. And this was going to be a big time commitment, and it's not my main job. My main job is to do research and to teach at Duke University.
Okay, so let's dig into what you believe. Of course, if you were being potentially called on by the defense, it would be, well, to defend what has occurred in the world of decentralization. But ultimately, what your argument is that, well, this wasn't really a decentralized finance problem going on. This was a more old school problem going on.
That's correct. So people believe this is a crypto problem, and there are some connections here. But this is like a traditional finance problem. This is a problem where you've got people running an exchange that have no idea as to how to run an exchange. No experience in risk management. And most importantly, the commingling of funds, which is the main thing in the case, where client money is used to bail out a hedge fund. So these are problems that could happen in traditional finance, but given that crypto is essentially unregulated, or a lot of uncertainty over regulations, many of these exchanges exist offshore. So FTX, Binance are examples of exchanges that are offshore to avoid the regulatory oversight. And that creates problems, as we've seen with FTX, but it's not the only exchange that suffered due to failures in risk management and other things.
Professor, from the experts and and founders and builders that we speak to in this space at the moment, it doesn't feel as though the regulatory environment is exactly tempting people to continue to build within the United States. In fact, it seems as though more are being driven offshore. Is that a risk at the moment? Is there some way in which the United States could be more attractive to ensure that, well, people can interweave themselves within crypto, they can safely use and exchange, and indeed whether they use it as an asset class or a way in which to develop technology?
So we're in a bad situation right now because there are very few regulations, and whatever regulations, it's kind of like regulation by enforcement. And given the uncertainty as to what the regulations will be, many companies are deciding it's not worth locating in the US. And no country wants to lose their best ideas to some other country. So I do think that there's a risk here that innovation does move offshore. And the next big thing in this space is not trading like with FTX and exchange where you're trading Bitcoin or Ether or things like that. The next big thing is how this technology is deployed in regular companies. So the top companies today. And this is the idea of Web3, where this technology can enable many things that were not possible before. And one example I like to give out is think of your computer. How much of the CPU and GPU do you use a day? Probably less than an hour. So why not rent out the other unused capacity and get paid for it? And that's what Web3 is able to do. So I'm actually quite concerned, given the harsh sort of regulatory enforcement rates right now, the lack of regulations, that we cannot participate in this innovation. We have two disruptions going on right now, AI and this decentralized technology disruption.
Professor Harvey, you authored a book, DeFi and the Future of Finance, that was published summer 2021. Had you been able to carry on your writing through present day quickly, what impact has SBF had on the future of DeFi as a standing point in history? So
what's really important to understand is that SBF and FTX is not DeFi. So it is centralized finance. In decentralized finance, you don't give custody of your asset to anybody. You're the person that holds custody. You do not delegate. And with FTX, customers delegated their custody, and then allegedly, those funds were taken and used for a hedge fund, the so-called commingling. So decentralized finance is sharply different. And I think that this whole scandal within FTX and the other bankruptcies, we've had many crypto bankruptcies, and almost all of them are centralized. These are an exchange, FTX, or lenders that were not experienced in lending or risk management. So I think that this actually shifts the focus away from kind of centralized finance to decentralized finance.
Campbell Harvey, great to have time with you. Professor of Finance at Duke University. We await the trial starting tomorrow. From New York, from San Francisco, this is Bloomberg Technology. Time now for Talking Tech. First up, Google will make its Chromebook laptops in India through a partnership forged with HP. Now, the deal is viewed as a win for all parties. Google can further compete with other PC makers. Production in India can help HP avoid potential curbs on imports. And India, of course, gains more production value from big tech companies. Meanwhile, go to the UK now. TalkTalk is selling its business-to-business unit to a subsidiary run by its main shareholders, valued at roughly $116 million. The deal comes as part of the British Telecom's reorganisation plan announced last month. TalkTalk is working against looming debt maturities, which need to be refinanced in coming months. Plus, in an effort to test its capacities, Elon Musk live-streamed himself playing Diablo 4 on X, formerly known as Twitter, of course. Now, the feed lasted 52 minutes, of which the first few minutes were spent setting things up with the help of some staff. A concurrent audience of 1,300 viewers, they tuned in with 20,000 total by the end, Ed. So one to be watching in terms of capacities, and there's been plenty of other sort of announcements coming from X today.
Yeah, it's interesting. I think there's also a partnership with Paris Hilton and 1111 Media for fashion-related video content, starting to get a sense of the developments on that platform. Now, Satya Nadella, the CEO of Microsoft, is calling out Google for its stake in the search market. Nadella took to the stand earlier this morning in the Google antitrust trial, leaving no doubt about his perception of Google's dominance. He also warned the judge in this case about how artificial intelligence could give Google an even larger lead in the search market. He basically said, Caro, that there being choice in the search market was a bogus, quote, idea.
Yeah, I think he's also been, of course, one of the key people behind the drive to make Bing something substantive in the world of search when it was first launched within Microsoft. And look, they couldn't get there. They didn't get there. Now, there might be lots of reasoning and blaming as to why that wasn't the case. But certainly, he's going to be trying to give context to the idea that maybe they couldn't muscle in and even offer even more money than Google than Apple was currently being potentially an offer to be that sort of a competitor on the space.
Yeah, let's get more context from Anurag Rana, Bloomberg Intelligence senior tech analyst. And Anurag, what do you make of this? There is choice. It's just that consumers are just using one browser, right?
Yeah, but I, to be honest, when I read the news, I was laughing because only a few months ago, Satya went on, with a massive offense with the browser wars, with his, OpenAI and the AI for Bing. And Google's market cap, took quite a bit of loss in those weeks to follow. And now he's saying that these guys have an advantage even in AI. So it's pretty amusing to me.
I mean, he went on to say that Google could extend their search dominance into AI, Anurag. And that hasn't been the feeling on the day-to-day discussion. I mean, as we've said time and time again, this timing of this trial is interesting, given the run for its money Google search is getting from generative AI.
Yeah, and then one of the things I talk to a lot of investors about is, when you look at something like an Apple has Apple Maps, and it's pretty crappy, and I've never used it. I still go out and open up an app that has Google Maps in it to do any navigation. Now, if for whatever reason, if I don't have Google default search on my browser, on my phone, I may be forced to download an app and that I can use search that way. At the end of the day, Google search is far better than anything else that's out there. And I think that's what Google is trying to make a case here.
Crappy, a technical term. Anurag Rana, we love it. Thank you very much indeed from Bloomberg Intelligence. Meanwhile, coming up, well, could we be heading towards a 3.5-day work week? Well, Jamie Dimon seems to think that we could be. Maybe that's the allure of artificial intelligence. More on what he thinks about where our kids are heading. That's next. This is Bloomberg Technology. Welcome back to Bloomberg Technology. I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco. Caro, quick check-in on the markets. Remember last week, the NASDAQ 100 just eked out a gain. We're up 0.3% in the session. But actually, most names on the NASDAQ 100 are in the red. It's the mega caps that are doing a lot of the work to keep this index in the green. One, I guess, surprise mover to the upside from a points perspective that is boosting the NASDAQ 100 is Tesla, actually missing on its deliveries and production numbers for the third quarter just gone. When the news hit in pre-market, the stock fell, and so did Rivian, which we'll get to in just 1 second, but it is rebounded to trade up 0.7%. I know we're going to get into the numbers themselves in just a second. Rivian is now down 0.2%. It's been kind of trading all over the place. It actually beat in terms of production and deliveries in the third quarter by some distance, but it maintained guidance of 52,000 units this year. And I know a lot of investors that we speak to in this program, Caro, they go, come on, Rivian, you can do more than 52,000. You've got, on paper, the ability to do much better than that. The market kind of shrugging its shoulders at this print, at least.
Yeah, it's been a mixed bag, to say the very least, to digest this morning. And let's get into that bag a little bit more to dissect the quarterly delivery and production data. Pleased to welcome Dana Hull, of course, who covers these companies. And start with Tesla, Dana, as to the reason that we saw this drop-off in deliveries, in production, and what it signals going forward.
Yeah, so the drop-off was forecast by CEO Elon Musk on the July earnings call when they basically said that they were going to have factory downtime as they prepare for the Cybertruck in Austin and really as they rolled out the refreshed Model 3 at Shanghai. So We knew that this was going to be a soft quarter. I think Wall Street knew. It was definitely a miss compared to what our consensus was. But the market reaction today has been pretty flat. I mean, it was sort of down pre-market, and now it's actually trading slightly above. I think the bigger news is that the company reaffirmed their guidance for the year of 1.8 million units. And that is, people are excited about that. The company is going to have to pick up the pace, though, in terms of having a record fourth quarter.
There's a lot of debate about the true story. Downtime for the assembly line so they can tool up for next-gen Model 3, Cybertruck.
Or is it a demand problem?
Or is it a demand problem? That's exactly where I was going to go. Is it a demand problem?
I mean, I definitely think that with high interest rates and inflation, buying a car is a huge purchase. And I say this as someone who is like driving a beater Subaru that I've had for 17 years. It is a big financial decision for many families and many people. So, some people are concerned that the factory downtime is obfuscating a demand issue, but we saw Rivian beat,
right?
And I mean, the arc of the future is electrification. It's just the macro is definitely a factor.
Rivian's interesting to compare and contrast. You more than anyone on the planet almost covered the sort of early days of Model 3 ramp, Tesla's first mass production model. Rivian's doing comparatively quite well in its first sort of 18 months of production. It's just that they spent billions of dollars to do it. And Tesla did it with no money at all.
Right. And a lot of people who work at Rivian were instrumental to that Model 3 ramp. So they've learned their lessons in terms of how to make a ramp go well. I think it'll be a really interesting fourth quarter to see what happens. The challenge that Tesla faces is that everyone in the United States is like, where's my refreshed Model 3? So they need to kind of clear out that inventory. And our opinion columnist, Liam Denning, has an excellent column today on this as well.
Looking at some of the analysis in response to some of these numbers, Rivian is seemingly sort of a positive news story. Evercore ISI coming out with an upgrading to overall where they think this business is going to go. They go to an outperform from inline. Ultimately, how are they setting themselves apart from a brand appeal perspective here, from like the desires to make these big sort of scale purchases with a Rivian rather than with a Tesla?
Well, I think that their strategy is really interesting. I mean, they are clearly squarely focused on the pickup truck market, which is where Tesla has lagged. A lot of people are wondering, where is the Cybertruck? We've seen photographs of the truck kind of around the San Francisco Bay Area and in Texas, but they actually haven't handed any over to customers yet. So the pickup truck market is clearly where Rivian is focusing, but then Rivian also has this incredible deal with Amazon for the delivery vans, and that's not a segment that Tesla has played in at all yet.
All right, Bloomberg's done a whole everything EV, but real focus on those Tesla numbers. Thank you. All right, JP Morgan over in London is hosting its Techstars Leadership Forum, which basically brings together companies and investors to hear from the industry's top players. Earlier today, we had an exclusive conversation with JP Morgan CEO Jamie Dimon. Have a listen.
It's a living, breathing thing. It's going to change. There are going to be all different types of models and different types of tools and technology. But the way to think about it for us is every single process, so errors, trading, hedging, research, every app, every database, you're going to be applying AI. So it might be as a co-pilot. It might be to replace humans. AI is doing all the equity hedging for us for the most part. It's idea generation, it's large language models, it's note-taking while you're talking to someone, and while it's taking notes, it may actually say to you that, here's the thing of interest the client might be interested in. All error, all customer service, it's a little bit of everything.
But it is going to replace some jobs.
Of course, yeah. But I look, folks, people have to take a deep breath, okay? Technology's always replace jobs. Your children can live to 100 and not have cancer because of technology. And literally, they'll probably be working 3.5 days a week. So technology has done unbelievable things for mankind, but planes crash, pharmaceuticals get misused. There are negatives. This one, the biggest negative in my view, is AI being used by bad people to do bad things. Think of cyber. Henry Kissinger talks about warfare. But the fact, and I do think eventually have legal guardrails around it. It's kind of hard to do because it's new, but it will add a huge value. And for JP Morgan, if it replaces jobs, we hope to redeploy people. Like at First Republic, we've offered jobs to like 90% of the people. They accepted, but we also, we've told them some of those jobs are transitory, but we hire 30,000 people a year. So we expect to be able to get them a job somewhere local in a different branch or a different function if we can do that. So, and we'll be doing that with any dislocation that takes place as a result of AI.
The biggest tech companies prop up a huge chunk of the S&P. Is big tech too big to fail?
I think that's a too broad a question. You know, I think in any industry, well, you say too big to fail, which I've lost touch with what that really means anymore. Because remember, car companies were bailed out, and these things were bailed out, and you know, I don't understand. They should ask what they want. If the regulators don't want a bank to ever fail again, then we should do A, B, C, D, and E. If that's the goal. I didn't think that was the goal. I think Dodd-Frank actually accomplished most of the goals, which is dramatically reduce the risk, create liquidity, capital, stuff like that. So, and big tech, you got to be very specific. You know, sometimes companies misuse their position, and sometimes they don't. Sometimes regulators capture it, and sometimes they don't. You know, but they're powerful. You know, and we have to deal with that. I've been writing about, you know, big tech going to our business. We got fintech, but we also have big tech, and they will embed payment systems in there. Some are going to white label banks, kind of what Apple did. You know, they have the right to do that. I'm not against that. I would be against unfair use of their position to dominate us in a business.
Well, Apple is going deeper into financial services.
No
Do you
question.
worry about the Bank of Apple?
I wrote about it. I wrote about it like 5 years ago. You know,
Well, how worried are you now?
Like, what is a bank? Well, we're going to compete. So they have a tough competitor, but you know, they hold money, move money. You could put money in basically, you know, markets, but it's a white labeled checking account, credit card, you know, all these things. Yeah, they're a form of a competitor. You know, we also partner with them, but I'm very used to partnering and competing with lots of people. So,
Existential threat?
I don't think it's an existential threat, but I think if we were complacent about it, yes.
The world of frenemies with JP Morgan CEO Jamie Dimon there. Meanwhile, coming up, we'll have more from that Techstars Leadership Forum in London with Matt Gale of JP Morgan. That's coming up. This is Bloomberg Technology.
All right, it's time for the VC Roundup. And first up, dozens of Japanese startups, ranging from software outsourcing companies to translation gadget makers, are preparing to list on the NASDAQ in the next few years. 7 of them in just the next few months. The trend follows a number of entrepreneurs turning away from an aging, risk-averse home market over in Japan. And Canoo entered into a purchase agreement with a foreign strategic institutional investor for an investment of $45 million with potential for upsizing to $150 million. The closing and sale are expected to occur as soon as possible. Plus, Sequoia Managing Director Roloff Botha applauds the changes at X, formerly known as Twitter. He spoke exclusively with Bloomberg's Emily Chang in London. Have a listen.
My first job opportunity in America was given to me by Elon, and it was to work for X.com 23 years ago. So it's an interesting full circle that it comes back. We're very enthusiastic about X. I think the things that have happened at the company in terms of changing the cost structure, streamlining decision-making to get much more rapid product evolution, record usage levels on the service, a reinvention of the business model, full transparency on content moderation and veracity. And so we're very enthusiastic about the future, and it's still early days.
That enthusiasm being shared from Techstars Leadership Forum. It's happening in London at the moment. And we want to have not just a conversation about what's happening in some private companies, what's happening in public world as well. From the event is Matt Gale. He's head of EMEA Technology Investment Banking for JP Morgan. And just we have some excitement of this transition from private to public once again. We've just had, 1, 2, 3 whole IPOs of size here in the United States. How is it looking at the EMEA level at the moment, Matt?
Yeah, I think it's a similar level of optimism. It's been a long wait for the IPO market to reopen. We actually did have 2 tech IPOs in Europe happen earlier this year, but it's really Europe looks to the U.S. capital markets to gain excitement. It's the deepest capital market in the world, and typically it opens up 6 months or so ahead of Europe for the tech industry. And so having those IPOs get out, get away, and get done has certainly raised enthusiasm here. And we can just see on the floor of this conference, we have about 50% more people here than we had last year. There's definitely a much more positive outlook from everyone you talk to. So we're not out of the woods yet for a tech recovery, but you can definitely feel we felt that we've hit the bottom and we're going upwards from here.
Matt, Arm's US listing was kind of like a starter gun moment here in the United States. Caroline just went so deep on that IPO day in New York City. But for you guys in Europe, was there a psychological blow to Arm choosing to list in the United States rather than in London or in Europe?
No, I don't think so. I mean, if you think about Arm, the heritage of the company is a British-founded but global business who then took some time off the capital markets to be owned by a Japanese company. What's great for the European ecosystem is Arm was able to list. It was able to list with huge demand from institutional investors, and it set itself up for great success in the capital markets. So when we think about European companies, we think about growing them and having them hit the capital markets. Where they choose to go is something each company needs to make a decision for itself. So long as they've got access to the capital markets, that's a great thing for the European ecosystem. So there might have been some hand-wringing here or there among some politicians, but for bankers, for lawyers, for consultants in the ecosystem, we're all super excited that got done, and it really should portend well for the tech ecosystem in Europe going forward. What
sort of areas of growth can we expect then? Companies going public, you mentioned there have been a couple. I'm thinking Lottomatica is probably one that you're discussing, and Ionos. These are companies that perhaps didn't get quite the exuberance of pricing at the top end of the range and then bouncing on the first day. How do we get excited about what's to come out of Europe, Matt?
Well, I think some of it has to do with just as the capital markets start rebounding. If you think about the IPOs that have happened in Europe, and you mentioned Ionos, that happened very early this year in a very different market. We're now in a position where the major indices are up, mid to high teens, in some cases more than that. So there's a much more receptive investor environment. The next thing we're looking for is for investors to be making money on the tech IPOs, because when that happens, that means you're going to see more IPOs. And then as you start to see the U.S. tech IPOs work, we're going to see more happen for the European names. I think what we'll see for European technology companies is the companies with global revenues are increasingly looking to the U.S. And that's primarily the software businesses, some of the fintech businesses that are based here but have a global footprint. The more internet, digital media businesses that have a European focus still really see the European capital markets as being attractive, but more so with a look toward 24 versus 23.
Yes. Matt, it's been an astonishing year for your industry. You forget that we started with the collapse of Silicon Valley Bank. And in the UK and in Europe particularly, HSBC moved in really quick to take advantage of some of the vacuum. Did JP Morgan benefit from the SVB collapse? Were you able to come in and find new areas of business in the tech sector?
Yeah, I mean, predating the Silicon Valley Bank collapse, we'd actually already started to really ramp up our offerings for early stage technology companies. We'd already been doing that for companies Series C and Series D. At the latter parts of last year, we started ramping an offering for companies from Series A onward. So we were very focused on supporting the tech ecosystem from early days, not just waiting for the IPO to come in. So certainly Silicon Valley Bank struggles maybe woke up some people at VCs and some technology companies that they needed to diversify their banking relationships, and being able to go to JP Morgan here in Europe and get access to our offerings on a global basis. I wouldn't say that hurt us by any stretch. It probably just raised the profile and maybe accelerated our ramp by a couple of months.
Matt Gale of JP Morgan, great to catch up, get the perspective from over in London and Europe. Thank you very much. Coming up here on Bloomberg Technology, we're going to talk about one of Silicon Valley's sports fixtures and mainstays in the community, the economic impact over the last decade of Levi's Stadium. SF49ers President Al Guido joins us on the show next. This is Bloomberg Technology.
Going viral. You'll have seen the pictures of Sphere Entertainment's latest venue in Las Vegas. And it just opened on Friday with a show by the rock band U2. Other high-profile events are scheduled for the rest of the year, and people are going wild for this event. Analysts attending calling it a revolutionary leap in live experiential. Company says it expects final construction costs of the arena to be pretty mammoth too, $2.3 billion. Shares, though, rallying hard today, up 16% in US trading, Ed.
Let's stick with live entertainment, the world of. But here in Silicon Valley, it's the 10th season of the iconic Levi Stadium in Santa Clara, next to its noisy neighbors, Apple, Alphabet, parent of Google. And It's been a big decade. There's a big decade to come. Al Guido, San Francisco 49ers president, joins us on set. You know, we always talk about the impact that big tech companies have in Silicon Valley. You guys are right in the heart of it, and you've put out some data on the dollars flying out of the stadium. Just run us through what you've announced.
Yeah, super excited to announce this morning that Levi Stadium in its 10 seasons has generated $2 billion of economic impact in our region, you know, employing nearly 12,000 people over those course of the 10 years. And Ed, I think really what's amazing in that is 2 years of that was really impacted by a global pandemic where we didn't have live events. So I think about it as only 8 years, and now looking forward to Super Bowl and World Cup, we're really excited.
The big story of the year for Caroline and I is this huge economic phenomenon called Taylor Swift. Have you heard?
It's for my daughters as well. I have 3 daughters, 14, 12, and 10. I know all about friendship bracelets. Yes, so fantastic.
You guys had a tour date in July for Taylor Swift, but now looking at what's happening on social media, did you guys feel that economic effect from Taylor Swift?
We absolutely did. $33 million, in fact, of that, which is the largest concert we've ever seen. I've never seen anything like it. She is a force to be reckoned with, as we know. And look, I think that is, to me, it's a microcosm of the power of live. Sports and entertainment is back. Coming out of the pandemic, we all thought, is this the pandemic bounce? It's not. It's here to stay. We talk about what we're seeing in the streaming world with people watching it. We talk about what's happening in stadiums with people going. It's never been better than it is right now.
I mean, we'll see when the Chiefs come to town how that affects all things of the games. But more, how are you trying to ensure that you're at the cutting edge? When we just see the Sphere, for example, I know when I was up there in the ordering my beers at the 49ers game, I was doing it all through an app, and that felt really ahead of the time in 2016. How are you continuing to iterate as you look towards the next 10 years?
It's a great question, Caroline, and we're going to spend about $250 million over the course of the next 10 years at Levi Stadium, updating and enhancing it, not just for the fan experience, but frankly for the events that are come. We were awarded Super Bowl 60, which will happen in February of 2026. We were also awarded the World Cup in the summer of 2026. That will not happen, obviously, in any other city outside of the Bay Area. And for that, you know, our fans, and not just our fans on 49ers game days, but fans around the globe, are wanting the best technology, they're wanting the best content, they're wanting the best experience. So we're going to continue to invest our dollars to make sure that happens.
And I think when you're thinking about the experience of artificial intelligence and all the ways that you can adopt, I mean, you're not only serving as president of San Francisco 49ers, but you're also part of a consulting firm where you're at Elevate, really thinking about how other companies are adopting all of this. It's happening quickly enough? Do you feel that really you're owning that space?
Yeah, I think it's a really, I mean, as you know, you report on it every day, it's an evolving space. And I think sports and the ecosystem that we see around it right now is to get to a point where we can increase the fan experience on game day. But frankly, that's only the 700,000 people that come to San Francisco 49ers games. If you think about the 49ers ecosystem from a fan base perspective, we have over 10 million fans across the globe. And so we think about ourselves as a sports and entertainment franchise that's really global in nature. And we need all these technology firms to help us reach those fans wherever they are.
For example, the rights that you have in the UK, international marketing rights, outside of the stadium, how are you going to grow revenue in eyeballs? Is it a streaming-first strategy? Because you're also bound by the NFL, so...
Yes, we're bound by the NFL as it relates to media rights, but we're not bound by the NFL as it relates to sports and marketing rights and marks in those markets. So, Ed, you're absolutely correct. The San Francisco 49ers have rights to Mexico and London today. And what we're doing in Mexico, we played a game there in Mexico City last year where we saw tremendous fan engagement. I think the highest gate in NFL history as it relates to an international game played. On the England side in the UK, not only do the San Francisco 49ers own Leeds United, which is in the championship now, but we are activating daily. I know we have a global watch party coming up for our game. We're playing this Sunday night in prime time against the Dallas Cowboys. So, again, it's all about reaching those fans wherever they are.
Brits, they love football in all its forms and guises. Al Guido, we love it. Thank you, President of San Francisco 49ers. Great to spend some time with you. Meanwhile, look, that does it for this edition of Bloomberg Technology, Ed. What a full hour we have.
Well, fast start to the week. Exactly. Recap on our podcast. Wherever you get your podcasts, you can find it on all the Bloomberg platforms, as well as Apple, Spotify, and iHeart. From SF in New York City, this is Bloomberg Technology.